Everyone is about to get clapped, in my personal opinion. We are heading into the Fed rate decision in about half an hour from the time of recording this video. If the markets are moving very volatile and crazy right now, it is because that report is out. We do have the summary of economic projections, which we are going to talk about all of this information. And if you are watching this after that report came out, this is very, 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 very important. So 1 hour from now at 2:30 p.m. Eastern Standard Time, I know the press conference will not be going on right now. That's what we have. Fed Jerome Powell comes out. He explains what is going on, why the Fed is making these decisions, and then he answers questions. And that is when you will get the real move. It is widely expected, if you have been on YouTube, especially, you've seen a lot of headlines like the Fed is about to rug pull us. Well, the markets are actually expecting a 0.75 rate hike, and I say expecting because the probability of a 75 basis point rate hike as of last week, call it Thursday before that CPI report came out, was about 3% of a chance, which was virtually nothing. There was no chance of a 75 basis point rate hike. CPI report on Friday came out, and on Monday, the probability for a 75 basis point rate hike went to 97%. So it actually flip-flopped. That 3% went from 3% odds of getting a 75 basis point rate hike to 3% chance of getting a 50 basis point rate hike. So the question is, for me at least, is 2 days enough time to really price in a 75 basis point rate hike and the Fed changing stance? As we know, at the last Fed meeting, what initially caused the markets to rally 3% was Fed Jerome Powell saying, well, 3% that same day in about an hour and a half time, was Fed Jerome Powell saying, hey, we are not actively considering 75 basis point rate hikes, but if the data does support that we need to do that, that's what we are going to do. And that's where we're currently sitting right now, and that's what we're faced with. As well as that, you do have the economic projections that are coming out. We'll see if the Fed tries to get markets credibility, if they are honest with where they see GDP going, inflation, all of that, which is going to be really bad numbers. Let's just be honest here. If the Fed is honest with markets, they're going to come out and say things are not good, you need to be worried, and essentially, we're not going to get a soft landing. We're going to get a recession, just all around bad things. So there can be good and bad out of that. The fact the markets are up so much today does lead me to believe you might see a lot of that negative downside, and essentially everyone is screwed at the current moment. Everyone from hedge funds to individual investors, anyone that has not been burned already is likely about to get burned here in the short-term future. We are seeing, look at this headline: hedge fund selling was never more furious than in last 2 days. The smart money dumped stocks at the fastest pace on record as a vicious sell-off sent the S&P 500 into a bear market. Now, I doubt Bloomberg will actually let us read this article. I was actually wrong. We can read this article. It says hedge funds tracked by Goldman Sachs Group Inc. offloaded U.S. equities for a 7th straight day Monday, with the dollar amount of selling over the last 2 sessions exploding to levels not seen since the firm's prime broker began tracking the data in April 2008. The equities came as the equity rout worsened amid concerns that the Federal Reserve will need to hasten its inflation-fighting campaign at the risk of causing an economic recession. As stocks careened, the Treasury yield spiked, the fast money rushed to double down on bearish wagers. And look at that. There is the selling pressure. Still not even, 2020 was nothing compared to the dollar amount that even got sold over the last 2 days. Absolutely insane. It says, in a note published Tuesday, Goldman said short sales at its hedge fund clients climbed aggressively, with broad-based investing strategies or macro products like exchange-traded funds dominating the flows. Quote, they're saying the market's going down further, Benjamin Dunn, president of Alpha Theory's advisor, said by phone. Sentiment is just pretty much in the toilet. And that's literally the words that I've been using. It's in the toilet. Now, the equity sell-off picked up pace after Friday's hotter-than-expected reading in consumer prices dashed any hopes that inflation was peaked, or has peaked. With the Fed scheduled to announce its monetary policy decision Wednesday, traders have amped up wagers on a 50 basis point rate hike. Alongside the 2022 carnage, hedge funds have slashed their equity exposure, a gauge of their risk appetite that takes into account both bullish and bearish bets, known as gross leverage, sat near 5-year lows, Goldman data showed. At Monday's close, the S&P 500 tumbled more than 20% from its January peak, entering a bear market for a second time in as many years. The benchmark index slipped 0.3% as of 11:20 a.m. in New York. And that's basically it. That is very, very bad. Long equity exposure at its lowest levels, short positions at their highest levels, and this is quite honestly way too late to be putting on massive short positions, in my personal opinion. You are going to get destroyed if you are now just loading these short positions on, because you've already took a massive loss in the overall equity markets. I mean, look at the NASDAQ. It's down 30% year to date. Like, come on now. The time to put on shorts was, in my opinion, a while ago. So, only my opinion. But I think everyone is about to feel a little bit more pain than not. And you guys can even see this in what's going on with hedge funds. So, hedge fund backed by legendary investor Julian Robertson closes. Tiger Legatus shuts doors as equity funds suffer worst start to a calendar year. And then you can see crypto hedge fund, Three Arrows Capital, tweet, fuels speculation over losses. Everyone is feeling these losses. These hedge funds are getting destroyed. Okay? So if we get another big jump in bond yields, which will happen if the Fed raises rates by 75 basis points, this yield is going to go higher on these bonds. There's no other way around it. Than 3.4% yield. It's going to go higher, and that is going to push equity prices down. That is the direct relationship that you will always see, is when bond yields are down like they are today, stocks are up. When these bond yields go up, stocks are going to go down. And if the Fed is set on this, if 75 basis points becomes the new normal, and we're going to expect multiple 75 basis point rate hikes throughout the rest of this year, getting the federal funds rate up to 4 or 5% possibly, then the 10-year treasuries cannot stay at 3.4%. And that is what is going to push the markets down, in my personal opinion. And over the last 2 days, to see a lot of shorting activity, then to see the markets up, the NASDAQ almost up 2%, the S&P up 1% heading into this Fed meeting, it looks like the only place for the markets to go is down. Now, if for whatever reason, I'm not a fortune teller, I just firmly believe over the next couple of days the markets will come down more. But if they don't, that's where you could see a lot of gains for something like AMC stock in a very short amount of time. Let's run through this data in case you guys have not seen it for the day. A lot of call activity that has came through for the day. A lot of those $14.50, $13.50, $15 calls coming through, but you do have some $12.50s and $12 puts that are also starting to come through as well. The positive order value for the day is about 71% overall. Now let's look at the short interest, because the short interest has climbed yet again today, about 3%. Short interest currently sitting at 22.96%. Current shares that are sold short of 118.38 million. Cost to borrow minimum 11.66%. Cost to borrow average of 20.99%. Cost to borrow max of 33%. Now, on top of that, free flow out on loans sitting at almost 38%. 100% utilization, days to cover at 3.76 days to cover. So a lot of this data, all of this data is primed to see a major rally. And like I said in the last video, call it a gamma bounce, a mega bounce, whatever you want to call it. But when you only have 2 full trading days left to expiration and you have 367,000 calls that are out of the money and approaching key levels like the $13 strike, $15 strike, the $20 strike, so on and so forth, that has a lot of open interest, that can also drive up the price of AMC in a very dramatic way if we do get a bullish reaction. Now, I don't expect to get a bullish reaction, but if we do, for whatever reason, Keep in mind, Nasdaq's down 30% already to start off the year. So, you know, to see a bullish reaction, it wouldn't be like, wow, we're so overbought. How did the markets not fall? No, you're down a lot, right? So there's that. That is probably the single most bullish thing you guys have going for you right now. If you want the markets to rally after the Fed because they're just down so much. At the same time, you have puts in the money sitting at 119,000. That is a lot of shares that will have to be hedged for, will have to be bought by the market makers. So that is basically that. There's the bullish case. There is the bearish case. This report comes out now in 20 minutes, but don't make any final decisions, or at least I strongly encourage you not to, make any final decisions until you do get Fed Jerome Powell, until you see what he actually says. The initial reaction, like we seen last Fed meeting, was a 3% rally in the last hour and a half after the Fed. After the conference, right? A 3% rally. We were down 1%. We closed the day 3%. So technically, it was a 4% round move in the last 2 hours of trading. But what the Fed said was not so good, right? People didn't like the fact the Fed took 75 basis points off the table. People didn't like the fact that the Fed was calling out China as a major risk to our economy. What happened the next day? The markets dropped almost 6% on the Nasdaq. So don't make any conclusions. If there was any day to stay tuned to this channel and to watch these videos, it is today. You want to know the details of what is said after 2:30 p.m. I will make it a point to get that video out to you guys before the markets close. So stay tuned for that one, because depending on what the Fed says, that is going to give us the move over the next couple of days. And this could be a massive opportunity, not only for just the trade, not only for just, what's going to happen over the next couple of days, but potentially what could also happen to some of our favorite stocks like AMC. So that is going to be all for this video. Wanted to keep this one nice, short, sweet, straight to the point. Hopefully get this video out before 2 p.m. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. If you guys want access to all my trades in real time, link down below in the pinned comment. Thank you for watching, and I will see you in the next one.